You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Bob Hoye. He's the Chief Investment Strategist for InstitutionalAdvisors.com. Welcome to the show, Bob.
Yep. Jim, good to be with you on, I hate to say it, a rainy Friday in Vancouver. But that's all right because it's been a very sunny couple of days in the stock markets.
Well, that's good to hear. And the question we're asking right now, how high is high?
Well, it is a fascinating market because we built through the summer with all kinds of momentum and sentiment figures right up there that you usually see with a cyclical peak. And then the question then going into when it was going to break, whether you would get a correction or something more severe. So we got a little bit of both. The S&P, I guess, was down 9%, so that was a correction. And then you had the Russell 2000, maybe it was about 18 or 19%. And then you had the European stock market, STOX, it was got a good whack. So it depends where you were. But, you know, we use the S&P as the pulse of or represent the big stock market. So then it got hit along with junk bonds and commodities and things like that. It was into a downdraft, and that sort of ended about the middle of the month. All of a sudden, wham! Now what we had, that's the middle of October. What we had was on one of the influences on the stock market has been the junk bond, and it was down to what we call a springboard buy. Boom! And we were getting oversold readings in the S&P, so up she came, and you'd figure, okay, this has been a big market, and we want to go up and test the highs, or, you know, towards the highs. So we got up there, and within about 2 weeks, the rise in the price of the junk bond was dynamic enough to give the opposite signal, like a springboard sell, and it has been coming down, but they've gathered together to make sure that stocks never go down, or at least if they do go down, not too much, because you had very positive announcements in the middle of October from the head of the Fed in the U.S., and then Draghi at the European Central Bank came out and said he was going to buy everything in sight, although I don't think they've been able to exercise anything like that on it. And then you had the Bank of Japan come out, and they were going to do an instantaneous 5% depreciation of the currency. And then now you've got more. Today, Draghi and the ECB came out and said he was going to promise to do more recklessness. So they had some good economic numbers, and boom, the stock market jumps 100 points. Well, it was up more than 150 at one time, which is now you've had a week of getting to new highs for the senior indexes.
Bob, I don't understand. They said more recklessness? That's like someone saying, I'm going to get drunk and drive real fast in my car and see what happens, isn't it?
Oh, yeah. Somebody very wisely said, maybe 15 years ago, when the Fed is the bartender, everybody drinks until they fall down. And we had a fall down in 2008. And there has been no fall downs in the stock market since. It's, you know, next year will be 6 years of rising stock markets. And, but there is a sense of artificiality in there. The senior central bankers are playing a very open hand. They do not want stock prices to go down. They do not want junk prices to go down. They don't want anything to go down, but what they're really working on, and this one is truly bizarre, is they want to get the CPI rate of inflation up to 2%. For some reason below that they don't like. And let's look at that. I remember seeing a chart here recently where if you take, since 1914 when the Fed opened the door, and the purchasing power of the U.S. dollar, it's declined at, I think, 3% compounded, and that means $1 of 1914 is worth about 3.5 cents now. So then if you depreciate it by 2% compounded annually, gosh, $1 would be worth 8 cents now. Or, you know, don't quote me on those numbers, just off the top of my head here. So they're recommending a 2% rate of inflation forever, in which case everybody knows. But what you've got here is that it's not really going into the economy, although in the U.S., car sales have been very good, and that includes light trucks, the whole thing. And this is being funded by an instrument where they take and bundle up loans, car loans, where those who are buying the cars and borrowing the money are paying something like 20%. And they then bundle those up and put them into a bond, and then institutions and investors are snapping them up. And there was one here done a couple of weeks ago. I think it was a bit richer than 18%. And the high yield is telling you is risky. And it was snapped up, and there was 4 times oversubscribed for it. But let's just see what they're getting. A bundle of bonds of dubious character. The loans may be out 72 months on the car. By that time, it's well depreciated, and many of the buyers are on the edge of bankruptcy, like payday to payday. So it's looking like when the government in 2005, 2006 in the U.S. was urging the mortgage companies and banks to lend money to first-time home buyers who didn't have the wherewithal to buy them. And the government was forcing the banks to do this, but then it all became a party. So there's not much of a party in the recovery in housing, but this thing with cars now is a party. The peak for the bond market, the lower grade bonds, was back in June. And here's another comment on the cyclical nature of credit, and the high confidence in financial markets then drove the yield on junk bonds down to about 5%, which is absurd. And then they're up to beyond 6% now. But when they were doing that, the spread between junk bonds and treasuries, the difference between, high yield or high grade credit and low grade, narrowed right in, and that was until June. And then on our work, we expected that those spreads to start to widen, and they have widened. And we put up a chart showing that particular spread. It was the triple B versus the Treasury, and compared it to the widening through the summer of 2007, and it's looking similar. So on the credit market side, you have had a veritable binge in borrowing and buying of bonds and very risky stuff. You've had the Fed buying treasuries and also buying subprime mortgage bonds, which was, of course, part of the housing bubble back in 2007. Now, that program has stopped, but effectively the European Central Bank is talking it up. I don't know whether they've been buying much bonds yet or not. I think you have to watch and see any reports on that.
Bob, maybe we'll take a look at the bond market right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Bob Hoye, market historian and chief investment strategist for institutionaladvisors.com. Bob, some people are saying the long-term outlook for bonds is horrible if the stock market continues doing what it's doing.
Yeah, well, there's the old recipe that if you got a strong stock market, bonds will go down. And certainly there is, that's been sort of working between the stock market and the long-dated treasury. But you've got all the lower-grade bonds that have been going up in price with the stock market until June. Then they've been checking back, and in the past, this widening of credit spreads has led to, it's indicating liquidity is drying up, even though the central bankers are pumping it in, but nonetheless, M2 and things like money supply continues to contract. So we are, as we've been saying, the first business recovery out of a classic crash, which was 2008, and you've had a business expansion with that, but it has not done much for the employment numbers in the U.S. If you take out those who have given up looking for jobs, sure they're talking about 6% unemployment, but that's a bogus number. So now you've got credit spreads widening, and this is a precursor to a credit contraction where, and we keep the old saying in mind that credit is suspicion asleep, or credit is money of the mind, and you can see it change. So let's put it this way. The change to widening spreads began in June and is now becoming impressive. And you have a stock market that's being ginned up by central bankers with very positive statements, and it works. They're heading it up. So, but here now, we're now back again to extremely high sentiment numbers and momentum. You've got, what was it now? The number of days the stock is well, there are a series coming in here now that you haven't seen in years, with the number of days of advancing, staying above a certain line is just getting to be remarkable. So what we're doing here is we had the springboard buy in the stock market in the middle of October, and it's still going. We had a springboard buy in October a year ago, in 2013, and we thought on that one the market might make it through until maybe February or something like that. But who knows how far? But it's, as of this week, the stock market is becoming impetuous, and how much longer they can keep it going, I don't know. On the other hand, we're now looking at some of the commodities, and I think today's rally in crude oil really helped the stock market, where we were looking for a low in copper in around November sometime, and we could be getting it. The other one we were looking for a low in on an important commodity would be crude oil. And yes, it's come down very hard, and that low we were looking for in December, but hey, we're obviously going to get a trade out of here now. Just became overdone, so could rally for a bit. Now, the sector we've liked for many months now, the grains, that's on the GKX. Yeah, they got so beat up 4 months ago. Just, everything was there, sentiment against it and momentum and everything else, so that we thought, hey, this one's the worst group. Maybe it can stabilize and recover, which it has been doing. The grains have had a couple of corrections, which is constructive, and they've been on one here more recently. So that side, we look at positive in that one. And as to a trade on crude oil, I wouldn't go long myself, because there might be a big geopolitical game going on here whereby it would be very constructive for geopolitics to have crude continue down, because the bad guys over there in Russia, as Putin's trying to create let's call him a neo-Soviet, without the money he becomes disarmed. And then, of course, the bad guys in the Middle East, if their price of crude keeps dropping. So that's why I won't trade the long side on this. We got to go back to June, July, when the energy side was very positive, and the oil patch stocks were doing very well. Well, we had very overbought stuff on that, and sequential sells, and a number of tools to say let's get out of that sector. So it's been beat up, and because of this geopolitical risk, I wouldn't trade the long side of it. We did trade a couple of times the natural gas contract on watching for the first wave of cold weather to come through into the continental U.S., and it has done that. It had a good move, and then now it's looking for the warm weather to come in, or at least a break in the weather. So I wouldn't trade that one either. So then we get out into our precious metals sector, and it was about 2 weeks ago, Kim did a whole review on the sector and what works and what doesn't work, and pointed out that when you're in wild credit markets, the usual thing that gold and silver bugs do is to analyze supply demand, and then they think they can somehow figure out where price is going to go on that. And of course, you can say that every year the silver bugs say that there's been greater consumption of silver than the supply is, so therefore it's in short supply and it's going to go up. But we always like to point out that silver and gold, between the two of them, they trade off the changes in the credit markets. And so now we are here now. Our last sell on the sector was when the silver-gold ratio got up to 84 in April, May, earlier in the year. And it was to take money off the table, and we're glad we did. Now, also, around September, we started looking at the sector and saying, maybe we should be looking to buy some gold stocks on weakness towards the end of October, and the weakness continued 2 weeks later, and it looks like we got a low in here. The comfort we're looking for is to have the gold shares outperforming the bullion price itself, because on the way down, the gold shares were getting beat up more than the price of gold was. And then for the last few weeks, it's been had a bump up and then checked back and tested the low and then another bump up. So we're getting the turn towards gold shares outperforming bullion, and that's constructive. And so the view now here is they've got a bit ahead of themselves. There have been some really good moves in the gold shares. But we'd like to think we could buy the dips. I wouldn't trade out of the move that we've had so far, but just to buy the dips on that. But the comfort in the gold sector is that you've had the real price of gold, and as we calculated relative to commodity, it's been on the way up since June, and this is now, it's good, technically good. It's had a few corrections and it's moved up, but we think it's a proxy for the profitability of the industry. If you got the price of bullion going up faster than the cost of mining it, you're making money. And this has been indicated by this gold divided by commodity index since June, and we think it's made a cyclical turn and it's got a long ways to go. So this is a new probably the start of a cyclical bull market for gold's real price, and it will be followed by a cyclical bull market for the gold shares, and we think we're just in the bottoming process of that now. So, happiness ahead later in the year in the gold department, sure thing.
Thanks a lot, Bob, for chatting with us.
A pleasure to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. You can forward comments about the show, or if you have any questions, to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.